Welcome to Growth Investing Mastery. This video will look at our September 2025 Growth Stock Portfolio Review. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to review our growth stock portfolio. We have a disciplined approach which gets results, and our strategy is comprehensive. The year-to-date returns for Growth Investing Mastery are 136%, and since the start of 2024, the channel is up 481%. Taking a look at our allocations, we have three high confidence positions, which are Iren with symbol IREN at 17.6%, AppLovin app at 17.4%, and Astera Labs ALAB at 16.8%. Our confidence is about equal on these three positions, and we've been rotating between them depending on the prices. We then have four medium confidence positions, which are Electrovaya ELVA at 10.9%, Hive Digital Technologies, Hive at 7.8%, BioHarvest Sciences, BHST at 6.8%, and Health and Tech, HIT, at 6.3%. Next up are three low confidence positions. We have Applied Optoelectronics, AAOI, at 4.1%, Reddit, RDDT, at 3%, and Dave Inc., Dave, at 2.9%. Lastly, we have four more companies, which we call microcap ventures, and that's a concept we introduced in our last video. The idea here is we do the same amount of research going in, but we don't do much earnings prep, and we wait to see where these companies land next. The first of these is Organigram OGI at 3.1%. That's followed by CPS Technologies CPSH at 1.9%. Then we have DUOT Technologies DUOT at 1%, and Zoom Technologies ZOMD.V at 0.5%. And you might have noticed that Organigram is actually higher than Reddit and Dave right now, but I'm still considering that a microcap venture the way I'm treating it. Additionally, the company BioHarvest Sciences started as a microcap venture, but we've moved up our allocation a lot there as our confidence has grown significantly. Taking a look at our results, in 2024, we were up 146%, and in 2025, we're up 136% year to date. The cumulative return since 2024 is 481%. And you can see on the graph how steep that rise is. A big portion of that jump up comes from Iren, which more than doubled this month. You can also see how harsh the downswing was in the earlier part of the year, but also how fast it recovered. Let's jump right into the stocks. First up is AppLovin with symbol app, and their product is an ad tech platform that's moving into web. I wrote here, I'm giving a free pass for the Q3 earnings because the company is currently limiting growth. The web pilot just launched on October 1st on a referral-only basis. I like this quote from the last earnings call. Management said, "We have one of the most lucrative financial models the world has ever seen." AppLovin is allowing any business, any size, anywhere in the world to grow profitably. The company is growing advertisers outside of gaming, and they said you're going to see a lot of upside in the numbers that we're able to report. They mentioned in the latest earnings call that Meta has a longer attribution time frame than the Axon platform from AppLovin, and this means that AppLovin has a competitive advantage now. The CEO recently speculated that the business may become 90% web and 10% gaming. This was really shocking to me because gaming currently accounts for over $1 billion of revenue right now. And I might have expected him to say 50-50 or 70-30 web, but 90-10 is a really crazy ratio to have there. The company says they're ahead of schedule on the roadmap for rolling out the automated web platform. And I wrote here, buckle up for a fun quarter in Q4. Our next highest confidence position is Astera Labs with symbol ALAB, and their product is AI Infrastructure 2.0. And this past couple weeks, the stock price has gone down quite a bit. as Morgan Stanley is playing games with the stock price. Their research arm is continually putting out incoherent pieces on Astera, filled with logical inconsistencies and even grammatical errors. They also did this about 6 months after the IPO, where they downgraded Astera because of Blackwell. They lowered the price from an $85 target to a $55 target. But the composition of the report was extremely sloppy. It had missing grammar, run-on sentences. It didn't even really make sense what they were saying. And the most bizarre part about this all is that Morgan Stanley was the lead underwriter for Astera Labs, a role that typically promotes the stock. If you ever saw the movie Wolf of Wall Street, the firm Oakmont Stratton was promoting Steve Madden. And Leonardo DiCaprio gave this crazy impassioned speech about how they have to go out and push that stock to every one of their clients as hard as they can. But the nice thing is this downturn in price presents a compelling opportunity to add to our position. Astera's Scorpio product line is scheduled to be the largest product line over the coming years. The company is moving from less than $100 per accelerator to multiple hundreds of dollars per accelerator. Astera seems to have some upgraded partnerships, especially with AMD, who is committed to the UA-Link consortium. They've said all future product lines of their chips will be built using UA-Link technologies. And that likely means a whole lot of collaboration with Astera on building their next generation of chips. Astera mentioned they have over 10 platform wins with an anchor product, and that's Scorpio. One analyst noted on the latest conference call, there's a bit higher content on the ASIC side. That came as a surprise to me because I considered their main market Blackwell, and I think a lot of people do. But the non-Blackwell market is actually a larger TAM for Astera than working with NVIDIA. Something that really stood out from one of their investor conferences was that they seem unconcerned about the threat from Credo. They said, "We're not trying to be a manufacturing house for cables." And they continued, "We'll leave it to the experts." And by the experts, I believe they mean Credo there. Moving on to our third high confidence position, we have the company Iren with symbol IREN. They are a neo cloud that's bootstrapping through Bitcoin mining. And the company is scaling up by roughly powers of 2 for purchasing AI compute. What I mean is they first purchased 6,000 Blackwells, then they bought 12,000 machines, and now they're looking to buy 24,000 machines. And I see them continuing in this pattern of roughly doubling the amount of Blackwells they're buying. One recent quote I like from management is that we're scaling across the full AI infrastructure stack, from grid-connected transmission line all the way down the digital well compute. Vertical integration gives Iren control over key bottlenecks. This allows them to achieve accelerated delivery timelines with rapid, low-risk scaling. And they said low-cost GPU financing structures lead to compounding shareholder value. Demand is accelerating faster than supply, they said, and there's strong customer traction at Horizon 1. Here's an interesting quote. They said the large customers don't want your software. They want their own software. And I think they're referring to CoreWeave and Nebius here, who are doing a software-first approach for pitching to customers. And Iren's really saying that customers want bare metal. So it's a different perspective here. One interesting quote was they said, "We don't envision stopping building new data centers." So even though they have 3 gigawatts contracted, they plan to expand well beyond that in the future. The company is also ramping up on marketing and social as they expand their brand, and they're also expanding their marketing team. Another quote I picked up from my mid-season earnings review was Iren saying, "It's like Groundhog Day from Bitcoin." Management said every man and their dog promises certain amounts of capacity online by a certain date, and no one does it. No one hits the schedules. Everyone revises them downward, stretches them out, cost blowouts, etc. because the real world is hard dealing with large-scale infrastructure projects, large-scale workforces, complex project delivery, safety. Like, it takes a lot of work and systems and structures to deliver that. And here again, some competitors are reported to be behind schedule, so Iren's calling that out a bit. Our first medium confidence position is Electrovaya with symbol ELVA. Their product is safe and performant lithium-ion batteries used in industry. And they have industry-leading cycle life, outstanding safety, and competitive energy and density. There's steady order flow backed by a much larger pipeline of projects. Management said we have the right product available at the right time. Electrovaya recently announced entry into the airport ground equipment sector. They're also expanding collaboration with a global defense contractor, showcasing safety and the cycle life. They mentioned some material handling customers are interested in the energy storage solutions as well. They said, we will make energy storage system deployments in 2026, and it's a large sector that is growing quickly. The company is currently taking in more orders than shipping, and they have rapid order intake. They're catching up and scaling up. Electrovaya's manufacturing plants can launch new batteries quickly because the technology is similar. One financial that I liked a lot is that the net income on the latest quarter is 1.3 million, and that's versus negative 1.4 million a year ago. So the company is sustainable on profitability now. And that's very unusual for a battery maker of their size. The Jamestown production facility is eligible for the 45X production tax credits. So even though this is technically a Canadian company, they still get those same manufacturing benefits as an American company when they set up shop in upstate New York. Electrovaya fully scaling up with their plans will go from 300 megawatts to 1300, and that's a 333% increase. Their data analytics is moving to a more sophisticated AI-driven demand response system. Lastly, when I was looking at Electrovaya's market share for warehouse batteries, they have about 5 to 7% of the market in Canada and 2 to 3% in the US. So there's still a lot of market to capture just in warehouse batteries. Our next medium confidence position is Hive Digital Technologies with symbol Hive. They are a Bitcoin miner and a high-performance compute provider, and they operate out of Canada, Sweden, and Paraguay. They're a Canadian company, and they're massively discounted in the market at a 930 million market cap. And the reason I say massively discounted is they already have over 20 exahash, which is 2% of the global mining supply. They expect to get to over 25 exahash by Thanksgiving, and keeping in mind they started the year at 6 exahash. The company is fully funded, and ASICs are arriving on a weekly basis. CapEx is taken care of, as they said. Here's one quote from management I liked a lot. We are the fastest and biggest growth stock in the Bitcoin mining industry. They mentioned they have great uptime, low G&A, and their best in sector return on invested capital. They recently had a press release where they casually mentioned that top-line revenue is at a run rate of 300 million. And if we do some simple math here, we divide 300 by 4 for the quarters, and that means they're earning 75 million revenue per quarter. Keeping in mind they just reported 46 million last quarter. And if those numbers check out and I'm reading that correctly, this is going to be a huge step up in revenue in the next quarter. Their scalable model is rapidly being adopted now for sovereign AI and HPC. The Toronto facility is powering sovereign AI for Canadian enterprises. When they were talking about Buzz, their software platform for HPC, they said stand by for huge and exciting news. And I'm not even sure what that could be, but it sounds like they might be announcing a contract with a hyperscaler soon. Our next position is BioHarvest Sciences with symbol BHST. Their product is plant exomes, which improve health. I was recently describing this investment to a friend, and they gave me some feedback. They said the last time I remember you were this excited about an investment was over 10 years ago when you were telling me about Bitcoin. And this got me thinking, why am I so excited about BioHarvest Sciences? And it's because the leadership team speaks as if they were the first to land on the moon or the first to crack the atom. One quote from their special call was describing their product and saying, whilst preserving the planet for generations to come. And it seems like they really believe they may be able to save the planet with this product. There's two potential extreme outcomes here. The first is this is one of the most delusional management teams ever. And the second is this is a discovery which will alter the course of humanity. After looking into some of their scientific studies that got published, I have some confidence that their scientific studies are legitimate. They were published in publications like the International Journal of Food Science and Nutrition. Additionally, they have collaborations with the Johns Hopkins University and the American Diabetes Association. The company is set to release an electrolyte drink, which improves cardiovascular health, and that launches in October. And something to keep in mind here is this product is way different than Gatorade or Celsius, which tries to make all these health claims. And I think BioHarvest Sciences is the real deal here, and that's why I've increased my position significantly. Let's now take a look at the BioHarvest product purchase I made over Amazon. And I've got a picture of the two products I ordered. One was a tea sampler, and the other was the daily chews. And here's a pro tip for growth investors out there. If it's a consumer product that's easy to buy it ASAP. And this way you can rule out a lot of companies pretty quickly. In some cases, the packaging a company ships may give some details, or maybe the product just doesn't look as advertised. But in the case of BioHarvest Sciences, I've been pretty impressed with both the tea sampler and the daily chews. And we're really looking forward to trying out the electrolyte drink when that's released later this month. So sometimes we get to implement this strategy of buy what you know, or if you don't know, try to get to know it. And this is a very useful tool in our toolbox, but we need to know when to use it, like in the case of BioHarvest here. The next stock we own is Health and Tech with symbol HIT. They're a B2B insurance tech platform. Management says they see no competition for the business. Other insurance companies are not trading or buying from each other. And their most recent investor tech conference mentioned they have 6 new products in the works. These are prioritized on revenue generating capability and timelines. And that's really great to see when the management team can push the pace on product development. And they recently announced a new product this month as well. The CFO said insurance is 10 years behind banking in terms of technology, and banking is not very far ahead in terms of technology. Recently, they have been turning on the system to agencies that have hundreds of thousands of brokers, and the product is free to use. The company Vertigard, who they have a partnership with, started picking up volume on July 1st, and that's good for the next quarter because July 1st is the first day of the next quarter they report for. And this is a business I could see picking up a lot of momentum quickly because they're disrupting a legacy industry and they have very little competition. Next, let's look at Applied Optoelectronics with symbol AAOI. Their product is optical transceivers and laser components. And I don't understand the product too well, but that doesn't matter. I see this mistake a lot from growth investors where they want to have deep technical knowledge of all the companies they invest in. But the reality is that's not really possible. If you think about investing in NVIDIA, most people don't have deep technical knowledge of Blackwell. Their data center business makes up 60%,
CATV is 35%, and telecom makes up 4%. If I'm understanding this correctly, CATV is projected to more than double next year to 300 to 350 million of revenue, and the current run rate for CATV is 150 million. The company mentioned there's re-engaged hyperscalers, and they're seeing increased sequential demand. They're also broadening manufacturing capabilities and deepening customer engagement. The company is strengthening supply chain diversity and scaling their production capacity. They're doing this through expanding their Texas facility footprint, and they said production starts in the summer, so that should be live already. And the production expansion works across different product lines, and that's a good sign. They're currently doing 2-inch wafers, but they're moving to 3-inch, and that reduces the cost by 50 to 60%, management said. They also said they got a transceiver milestone for 400G, and there's increased sales in the second half with growing demand. Additionally, 800G products start shipping in the second half of 2025. They said it's late Q3 or Q4. There's 6 MSOs which have already begun to order in CATV, and MSO stands for Multiple System Operators in the cable side of the business. Later, management detailed there's over 10 customers in cable, not including Charter. And it sounds like a lot of deals are being signed right now. The company's been getting some great feedback from customers. They say it's game-changing performance. Our next position is Dave Inc. with symbol Dave, and their product is membership-based banking. My enthusiasm has come down a little bit since their initial report, and this is because I'm still trying to reconcile the higher revenue growth with the lower user growth. Revenue was up 64% year over year, and monthly transacting members were up 16% year over year, while the member base grew only 14% year over year. They did say we're still very bullish on our new customer ads, and they're ramping up their marketing spend. And I put an open question here, or are they doing a one-time juicing of their customers? Is the fee structure change the main catalyst for the revenue growth? They did raise their membership fee from $1 to $3, and that only impacts newer customers. They said they tested it a lot and got feedback, and it seems like members are okay with the price rise. Their customer acquisition costs have improved as well. It's 4 months now, down from 5. One promising sign is their extra cash originations are growing well. They were 1.8 billion in the latest quarter, which is up 51% year over year and 17% quarter over quarter. They have a new model called version 5.5, which is performing well. And I actually really don't like this naming convention for the public. 5.5 is pretty coder specific. It seems like they could do some better branding to announce this new version. Another big concern I have is that JP Morgan has some leverage over them on fees. And that's a pretty big rabbit hole to go down, how that fee structure works, but I just don't understand it too well. So that does give me a little pause on investing more here. One more low confidence position is the company Reddit with symbol RDDT. Their product is community-based social media, and they're the #1 cited domain for AI across all models. There was a recent story that AI chatbots are referring less users to Reddit, but this isn't my concern. I'm more concerned that other revenue, which is their data licensing business, was 35 million in the latest quarter, up 24% year over year. And that's in huge contrast to a year ago, when this other revenue was growing over 600% year over year. It seems like management themselves doesn't even understand why this part of the business is slowing. Here's a few quotes from management. Every variable has changed since we signed those first deals. They added, we're still, I think, getting a sense of how much people really depend on our data and what it's used for. So we'll see how to continue to develop. Another quote they added was, "What we've learned since we did those deals is that the Reddit corpus is not essential, but appears to be growing in importance." And from my perspective, that's really not a good sign when they thought this data would be essential for AI companies. But now, a year later, they're realizing these AI companies don't view this data as essential. Lastly, they added, "We're still learning how much folks depend on our data and what they use it for." They added they need to spend some time answering what the structures for the data look like next. And I do actually appreciate the honesty here. I think a lot of companies would try and hide other revenue at this stage. So hopefully they can go back to the drawing board and maybe create a SaaS product or something subscription based for this type of data. Additionally, the international revenue from translations doesn't seem to be moving the needle as much as I originally expected. Anecdotally, Reddit seems to have turned up the advertising dial already. About a year ago, I noticed there wasn't that many ads in Reddit compared to other social media, but now it seems like there's a fair amount more, so they may have already closed that gap. However, our overall takeaway is the numbers are strong enough and above expectations. We will hold despite the worsening narrative here. Starting off with our microcap venture positions. First up is Organigram with symbol OGI. They are the top cannabis producer from Canada. And we covered this company in depth in our last microcap ventures video. So if you want to learn more about the company, definitely check that out. Since posting that video, there's been some positive regulatory news in the US, which may add further tailwinds. I put the graph of the stock price on this slide because it's quite relevant to our thesis here. In 2020, when Organigram IPO'd, the peak revenue got up to about 20 million of quarterly revenue. But now in 2025, the company is delivering record revenue of over 50 million per quarter. Yet the stock is down 94% since its IPO price, and this presents a really compelling valuation now. Our next microcap venture is CPS Technologies with symbol CPSH. They make advanced metal composite materials. This company was also covered in depth in our microcap ventures video. And right after posting that video, there was a news story that came out that the Army contract for tungsten shells got extended. It seemed at first like the market read this as a completely new contract. However, the market did give back some of its gains because it looks like this was more a phase 2 addition to an existing contract. One of the reasons we like this business is the revenue is growing over 60% year over year. It's profitable and it has a tiny market cap. DUOT Technologies with symbol DUOT is another microcap we added to our portfolio recently. The company does edge data centers for remote locations. And this company has done a really big pivot in their business recently. I thought about including this in the microcap ventures video, but it's a bit harder to explain than some of those other businesses. They originally started out doing railcar software for inspection and automation. My understanding of this is as a train would drive through, they would inspect some aspects of the train to make sure everything looks okay. But more recently, they've been selling gas turbines for data centers, and a lot of those sales are in Mexico. The big pivot and the new product is modular data centers built in a shipping container. They're looking to have 15 of them installed by the end of the year. However, the payback period for these modular data centers is quite long, but they mentioned that companies sign long contracts. One thing I liked is that their guidance seems to imply $10 million revenue quarters. And that's keeping in mind the latest quarter was 5.7 million of revenue, which was up 280% year over year. However, they are negative on profitability. EBITDA was negative 2.6 million, and net income was negative 3.5 million. That's with a market cap of 155 million. I do have a few concerns here, and this is part of the reason this is a smaller position. I'm just not sure on the unit economics of these modular data centers. Additionally, there's been some share dilution and I think a capital raise as well. The old CFO is back. It seems like from the transcript, there was someone who was working as the chief financial officer, and they've returned to the company. I'm not sure what they were doing in the interim. The first time I tried to check on this company, the website was completely down, and that's not really a great look, but it's back up now, so maybe that was just a interim issue. And again, this is a venture style investment, so I'm unlikely to check back much until the next earnings, but I'm hopeful this company can do well. Our last microcap is ZOMD Technologies with symbol ZOMD.V. The .V there indicates the company is on the Venture Exchange in Canada. Their product is a marketing and user engagement platform. Revenue in the latest quarter was $19.6 million, which was up 40% year over year. And on profitability, it looks even better. Adjusted EBITDA was $5.6 million, which was up 80% year over year. And net income was $6.1 million, up 195% year over year. It's very rare to see a SaaS platform at this stage be GAAP profitable. There's huge SaaS companies like Cloudflare or Snowflake, which still aren't GAAP profitable. And this GAAP profitability indicates they're running a really efficient shop here. However, I think their prior earnings report may have had even more impressive numbers. And my position here would be larger by confidence if this was a NASDAQ listed company. I needed to move some money around to buy this properly on Interactive Brokers. I really don't want to go the pink sheets route. The pink sheets are just too unreliable for the bid-ask spread and the amount of low volume there. I'd really like to see this company uplist from the Venture Exchange on the Canadian side, and even better if they can dual list on the NASDAQ like many of our other Canadian companies we have. One company we sold this month was Credo with symbol CRDO. The CEO recently presented at the Goldman Sachs Communicopia conference. When I was reading the transcript for this conference, there was something very strange that stood out. There was one analyst who asked about pricing, and the response from management was, "Do you want me to talk about increasing pricing in a public forum?" He then did clarify it was a joke, but it looked pretty strange in the transcript. I actually went back and listened to the audio as well, and it didn't sound as bad in the audio. However, my big issue is he didn't really answer the question, and I would have really liked to hear an answer to that question. There was some mention that, of course, pricing is going up, but it wasn't clear by how much. And this lack of clarity for management on a number of topics is really starting to bother me here. Also in this conference, there was zero mention of their new Prism software platform. They announced that on the earnings call, but now they're not even talking about it, so that seems a bit strange. I really don't understand management's vision here. They make it sound like they're a wire manufacturer now. And this is in huge contrast to their main competitor, Astera, who's talking about UA Link in 2026, 2027. Credo seems content playing second fiddle here. They made an acquisition as well, which may indicate they're having trouble building their products organically. Something to keep in mind with Credo is that Amazon gave this company a lifeline 2 quarters ago, but every quarter since then, Amazon has been decreasing their spending significantly. Another big issue with management is they never warned about the 86% of revenue that would come from Amazon 2 quarters ago. And the CEO seemed unfamiliar with their software platform. It was poorly announced in their earnings report. Lastly, I really don't understand why this company is headquartered in the Cayman Islands. I've had a few people mention they have offices in California, but then why not relocate there? Overall, I lost all trust in this management team, which does a poor job communicating to its investors. Okay, now let's get into Nebius with symbol NBIS, which is a company I bought earlier in the month and then ended up selling. They recently signed a contract with Microsoft where the contract value
was more than the entire market cap of the company. And I don't ever recall seeing something like this before, except in maybe a microcap where a company signed a big deal, but it was typically their first deal. So this was quite shocking to see. I think the deal was 17 billion and the market cap was 15 billion at the time. And I ended up taking a starter position. But 3 days later, the company did a large debt raise. And this reminded us of why we passed on this company in the first place. While I don't mind the debt raise on its own, it was often said that the company has so much cash on their balance sheet that they could fund a lot of their projects through that cash that they have. I've also been a bit skeptical about this company for some time now. From my perspective, this is a Russian company that was rebranded in 2024, which isn't that long ago. And I'm kind of surprised that topic doesn't come up that much because I know there's a lot of investors who simply won't touch a Chinese company or a Russian company just because of the opaqueness of their businesses. Also, they're known for being fast and loose with accounting, so that's a bit of a difference from US regulated or Western regulated companies. Another thing that stands out is the CEO was previously sanctioned by the EU, but to be fair to him, he was unsanctioned after that. Nebius is also a VC investor. They have a ton of side bets, and I do believe their side bets are actually doing quite well from what I've read. I know some people consider that a big positive, but I like to see a company that's more focused. If we consider a company like AppLovin, they're selling off their gaming business. They're really looking to dial in and focus in on what they're doing. Something that's been really confusing me is why does every Twitter poster seem obligated to mention the engineer's skill level at Nebius? And only recently I learned their engineers are not even building the data center. There's a company called Data One in New Jersey, which is building the data center. But that builder is officially 2 months behind schedule. And I've seen some people sharing some weird stuff that Data One was sharing on LinkedIn. I don't want to go down that rabbit hole, but it was a bit off putting. Also, Nebius, or formerly Yandex, was always a software shop. And it doesn't make that much sense to me now they're a pure play hardware provider. What we hear from some others like Iren is they're saying customers demand bare metal, and they're kind of talking down that software approach. Again, to be fair to Nebius, they did say their software platform could improve the performance of the machines. And I'm not sure how that would be a performance over bare metal. I didn't think that was possible, but if they really do have an innovation like that, that could be a huge competitive advantage for them. But I'm really wondering now, are they basically a Microsoft subsidiary? Can they take on other customers now? And I'm wondering where the upside is now if they're unable to announce new contracts. So my overall takeaway is while that Microsoft contract is incredibly impressive, I still have a ton of outstanding questions about this business. Let's take a look at some promising new ideas. The first is called Next Vision Stabilized Systems with symbol NXSN.TA. They trade on the Israeli exchange and they make micro-stabilized cameras. Revenue in the latest quarter was 37 million, up 32% year over year, with net profit of 23.2 million, which was up 46% year over year. So you can see that profitability is growing faster than sales, which is pretty nice. Their product is used in micro and mini UAVs and drones, and they say they have ambitious sales targets. They're looking to get 160 million of revenue in 2025, and there's only 2 quarters left, so that implies they get 43.4 million on average for the next 2 quarters. However, my big concern here is the market cap of 3.5 billion is extremely high for a company getting just 37 million of revenue and growing 32%. Additionally, their active customers in the first half was 154 versus 137 last year. So their customer count isn't growing that fast, but it sounds like customers may be spending up. The next company we looked at is called GEVO Inc. or GEVO. I'm not sure how to pronounce it. It has symbol GEVO. They produce renewable fuels and sell carbon credits. Revenue was 43.4 million in the latest quarter, which is up 725%.
Additionally, the company is profitable with 13 million of EBITDA and 2 million of net income. However, a lot of that revenue growth comes from an acquisition. They purchased a company called Trail Energy for $210 million. And Trail Energy had an ethanol production plant. And they also had some data analytics for carbon tracking. The big reason I'm interested in this company is they seem like they're well ahead of their targets. And they even seem surprised themselves at the pace they're going at and the level of profitability they're getting. So we want to keep our eye on this one. The next company is called Lumentum Holdings with symbol LITE. They make optical communication products and commercial lasers. Their main business is in cloud and networking, making up 86% of revenue. And it's an industry which has a lot of tailwinds, as many know. Revenue was 481 million, which was up 56% year over year. They had EBITDA of 61 million and net income of 213 million, with a market cap of 9.3 billion. And usually you don't see net income above EBITDA like this, so maybe they had a one-time tax issue or tax credit, but I didn't look into that too much. And Lumentum is a spin-off from JDSU, a company that was a high flyer in the 1990s. The company does have a pretty high employee count, with over 10,000 employees. Also, the market cap is fairly large here already, getting close to 10 billion. And I feel like some of these prices and metrics may be too priced in at this point. However, if the company can keep growing or the valuation gets significantly better, we might start looking here. Taking a look at some more promising ideas. First is Advantest Corporation with symbol 6857.T. They're based out of Tokyo, and that symbol is not a typo. In the Asian markets, a lot of times they use numbers for their symbols. And I'm starting to see a lot more promising ideas overseas, so I'm really looking to get more set up with my interactive brokers, so I may be able to take advantage of some of these. Advantest makes automatic test equipment for semiconductors. And these numbers are all in dollars, not yen, just to make it a little bit easier on the comparisons. They had revenue of 1.83 billion, which was up 90% year over year. EBITDA of 903 million, net income of 626 million, and a gross margin of 65%, which is coming up from the 50% range. Their competitors include Nova, KLL10 Core, ASML, and Applied Materials. Nova is an Israeli-based company that we used to own, so we're somewhat familiar with the space, but it's a pretty hard product ramp up here. And I wrote here, the market cap of 57 billion seems pretty reasonable for this level of revenue growth and profitability. The company did mention they had pull through on sales this quarter, and that's really my big concern here. They did warn the second half of the year could be weaker. On the other hand, they did raise guidance. So I definitely want to let at least one quarter pass and see if that pull through happened or not, but I do want to check in on this company again. The last company we looked at is called Bravura Solutions Limited, with symbol BVS.AX on the Australian exchange. They're a cloud-based wealth management platform. And the company reports in halves, which can be a little bit annoying if you're used to the quarterly reports. The last implied quarterly numbers were 61.8 million for revenue, which was up 51% year over year. And that's with EBITDA of 27 million and net income of 4 million. So this company is already profitable. Geographic breakdown of revenue shows the UK made up 52% of revenue, Australia 18%, and New Zealand 5%. Their top customers include Lloyd's, BNY Mellon in the UK, legal companies, and trusts. The wealth management portion of the business makes up about 65%, and that includes pensions and life insurance. On the other side, fund administration makes up 35% of revenue. One concern that stood out quite a lot is there's an interim CEO. There was a previous CEO that left after turning around the company and restructuring it. And my last concern is that revenue's been in this 50 million range quarterly for quite some time. I scrolled back a few years and it seemed like they were growing maybe 4 or 5 years ago. So I'm not sure what happened then. Let's wrap up with some final thoughts on the month. We had the strongest month of the year so far for results, and it was almost a mind-numbing amount of gains. The market waking up to the opportunity in Iren was a big catalyst for our results. And we still have another earnings season left in the year to drive our results even higher. We've got 2 strategy videos in the works. The first is about measuring profitability, and the second is about multi-baggers, or how we think about that concept. And feedback on any video ideas is always welcome. So leave me a comment below if there's some aspect of growth investing you're more interested to hear about. As a last reminder, this is not investment advice or recommendations to buy stocks. Thank you.